Should Amazon and GrubHub's deal make DoorDash nervous? In a move that will demoralize personal trainers across the country, GrubHub and Amazon are getting into business together. The partnership was announced by GrubHub's Dutch parent company JustEatTakeaway.com, try saying that 5 times fast, with the company's share price responding positively to the news. The deal will see Amazon receive stock options that represent a 2% stake in Just Eat, and they'll also be given the chance to increase this to 15% if the deal works out. And it's not just Eat shareholders who are the winners from this arrangement. Amazon Prime members will be receiving a year's free subscription to Grubhub Plus, which gives customers free food delivery for what is usually a monthly subscription of around $10. It's a shot in the arm for Grubhub and JustEatTakeaway.com, with the food delivery space coming under significant pressure in recent times. Let's dive into this background and take a look at what this deal could mean for Amazon and Grubhub in the long term. Online food delivery has exploded in recent years, but its history in the US goes back to the mid-90s. Pioneering startup Worldwide Waiter started in California in 1995 and still exists today as Waiter.com, but it has been well and truly taken over by other companies since then. The industry has come a long way since the early days of Worldwide Waiter. There are a huge number of services fighting for market share, with new startups arriving on the scene all the time. Currently, the market is dominated by 4 companies: DoorDash, GrubHub, Uber Eats and Postmates, which has been owned by Uber Eats since 2020. Growth has been steady for a number of years now, but it accelerated rapidly after the onset of the COVID-19 pandemic. Prior to March 2020, food delivery sales were increasing at a healthy 7 to 8% per year. Between March and May, when lockdowns were at their most severe, demand shot through the roof and has continued to rise at a much greater rate than pre-pandemic levels. Despite huge increases in demand and revenue, food delivery services are struggling for profitability. They operate on razor-thin margins, and there are limited areas to improve those based on their current operating model. For example, restaurants tend to operate with profit margins of between 7 and 22%, and, yet, delivery services will generally charge the restaurant a commission of between 15 to 30%. Many are prepared to operate the delivery service as a loss leader to be a marketing exercise for their restaurant, but as the percentage of deliveries creeps up, the economics get wonky. There are many ways that the industry is looking to tackle this. One of the fastest growing in recent times are dark kitchens, which operate without a front of house and offer food for delivery only. Other innovations include improvements ranging from the simplistic, such as routing of orders and stacking multiple orders together, to the somewhat outrageous, like the use of delivery robots. Investors are holding strong in the belief that the sector will be able to reach profitability, and with sufficient scale, this has the potential to generate significant profits. For more updates and detailed information, stay connected with us and subscribe our YouTube channel. Thank you.